With mortgage rates being a little bit higher than a lot of home buyers, one thing to be right now, there's a lot of conversation about, hey, is it a good idea to buy down your rate? Well, what does that exactly mean? And when is that a good situation to take advantage of? We're going to try to explain that to you in this video coming up next. Welcome into the Smart Mortgage Show. Ben George with Bill Litton. He is the regional president at Cross Country Mortgage. And today we're tackling probably a question maybe coming up a little bit more now, and that's whether or not to buy down your rate. So, Bill, we're going to kind of break down, what this means, kind of how it works, maybe provide some examples of, times when it makes sense, times when it doesn't. So, again, the goal is to try to help inform people going into the process and giving them as much information as possible so they can make the best decision for them. But I want to begin with that kind of the idea of the buy down. What exactly does it mean? How does it work? Because I think we hear this and we kind of have a pretty decent idea of what it means. It brings the rate down, but how does it exactly work?
Yeah, and Ben, for today, there's different types of buy downs, but let's be specific on this. This is not a temporary buy down. Today we're talking about a permanent rate buy down. Okay. Which means that the interest rate, if it's a 30-year fixed, when we buy it down, that rate is bought down over the life of the loan. So for the whole 30 years, the rate will be lower. And because it's stretched over 30 years, so a 1 point buy down, and point and percent are pretty much synonymous. So if you pay 1 point or 1% of the loan amount, so in this case, let's say it's for example's sake, $100,000 loan amount. 1% of $100,000 is $1,000. So you're paying $1,000 upfront at settlement to the lender. And what that gets you is a decrease in the interest rate by 1/8 to 1/4%, depending on the lender, the market, and some of those details. So what you're doing is you're almost like prepaying some interest up front with the idea that paying $1 today is worth more than paying $2 in 5 years. And so since the lender gets, some more money right up front, they'll give you a break on the interest rate over time. And what we really need to figure out is, should we be paying extra for an interest rate that it might take you 2 years, 3 years, 4 years, 5 years to earn back what the cost of it was up front? That's what buying points is. Buy down the rate with extra money up front at settlement for a lower rate, thereby lower payment for the life of the loan.
Okay. Yeah. So this obviously doesn't apply to somebody that's buying a home and looking to move out in the year. So there is some math that goes into this, is most situations, right? What does the math tell us? So there has to be, I guess, a break even point in this kind of situation as you're working through the math to figure out if it makes sense, right?
Yeah. So basically, we always want to look at the break even point and say, based on, you compare a no point loan to a loan with points. And based on those two options, how long will it take to pay back the points, the cost? So for instance, this is just for example's sake. If you were to pay a point and it cost you $1,000 to do that, and it only saves you $1 a month, well, you'll never make the money back. So we would never do that. But if you paid $1,000 and it saved you $500 a month, you'd be paid back in 2 months. Absolute no-brainer. But in reality, it's always somewhere in between. It's never that easy of a comparison. One of the things that we like to think is, with the break even, that at some point, if the break even's going to be greater than 5 years, then it probably doesn't make sense because of two reasons. One is you're making a 5-year bet, and we're always making decisions today based on what our plan is. Our plan can change, but we got to base it on something. So we base it on today's plan. But the longer and further that is out from today, the more higher the probability or likelihood is that that plan could change. So we don't want to go beyond 5 years. The other thing is, when you get beyond 5 years, really with inflation and the time value of money, you're far enough out that your savings, even though you're saving money at that time, you're far enough out that it's been degraded enough that it's not close enough to the original savings. So our break even is how many months until you've saved the cost of the upfront points, and it really can't be greater than 5 years.
Okay. Yeah. Great breakdown. That's, again, kind of what the math tells us. What would the other variables be as you're kind of discussing this, Bill? Let's say, put the math aside for now and think about some other things that would affect the decision. What would you tell someone that's considering this?
Well, the other thing too is how much money do you have, like excess or expendable cash that you can use to buy down the rate? Because if you're going to use now we used an example of $1,000, but it could be $5,000, and that $5,000 could make perfect sense financially and save you money over time. But if putting that $5,000 out of pocket today puts you in a strained cash position, it's probably not worth it, not necessary. Having that cushion is definitely going to be more important. The other thing to keep in mind too is the opportunity cost, meaning like, could we have used the money somewhere else? So, okay, we could have used $5,000 to buy down the interest rate, which is going to save us X amount per month. But what if I took that $5,000 and paid off a 30% credit card? Probably better off there. So opportunity cost is really important as well.
Yeah, some good variables there. And I guess too, I think a lot of people right now are at least hopeful that they can refinance pretty soon down the road, right? I think, the hope is that, rates around, I think 6, 8, I think is where they are currently as the recording of this episode. But I think people hope they get down into the lower sixes or even tap into the fives again. If you hope and plan to refinance in the near future, obviously you can't predict what rates are going to do. So, maybe this doesn't carry a lot of weight. But if you are hoping to refinance soon, this probably wouldn't make sense either, right?
Yeah, Ben, that's a great point. And we always want to ask the customer what their understanding of where do they think rates are going to go. And you get varying answers. Some people have no idea and they're just looking for guidance. Other people have a pretty good opinion about it. If I'm talking to somebody who thinks that rates are not coming down for a long, long time, buying down might make sense. Somebody who's a little bit more aggressively thinking rates are going to come down, well, we want to be careful because we want to tailor it towards what their plan is. Of course, we're also going to lend our thoughts on where we think the market's going as well. And where those two plans intersect is really where the plan's going to materialize from. Unless they just have a really, misguided view and it's way off. And certainly we're going to be a little bit more expressive on letting them know. But people, they have a plan. Most people are pretty smart about this. We want to work on this together. If somebody thinks rates are going to come down in the next year or two, then we want to be careful because if it was going to take 4 years to pay off the cost of the points, we're never going to get there. Now, I will tell you, Ben, a lot of people that we helped buy down their rates starting in 2022, they're reaping the benefits because they bought down the rate. Rates have not come down enough for them to refinance. So it was a good bet because we bought their rate down and they're still enjoying that lower interest rate. And there really aren't other options to get out of that right now. So it's just strategic planning and really having those conversations to see, where people, where they see themselves. The other thing too, Ben, is, are you planning on moving, right? If your situation is that your job might take you away in a year, in that situation, and we see this a lot with veterans and VA loans, buying down the rate probably doesn't make a whole lot of sense because if it's 50-50, my bet is just don't buy down the interest rate because we just don't know. And there's a chance you're just going to spend money paying to buy down a rate and get no benefit.
Gotcha. All right, let's provide a few examples and Bill, maybe kind of paint the picture a little bit better for people that are, thinking about, hey, does this apply to me or not? So give me an example of maybe a time where it'd be a clear win to go ahead and move forward with buying down the rate.
Yeah. So if you're looking, let's say at a 30-year fixed rate loan, 450 loan amount, the interest rate without buying down the rate, which we call the par rate, 6.875. Okay, now paying a point, 1% of 450,000, so $450, the rate drops 0.25%, 6.625. The monthly savings on that is $76 per month. Okay. So this is one where, look, this I think is one where we got to be really careful. It could make sense. We're getting right out to that 5-year mark. And if the customer is one of those people who just likes certainty and they're not going anywhere for a long time, and they don't have a situation where they're depleting an important cash reserve, we might just say go for it on this one. Okay. But same scenario, Ben. This person is going to get transferred in 2 to 3 years, and they might not be there for the full 5 years to get the recoup the initial cost. In that case, we think paying points might not make a lot of sense.
So it really is, a lot of it does come down to your time horizon. How long you plan on being in the house. And if you're moving to a home that you expect to kind of, spend most of your life in, then could make sense. But again, go through this process with a good lending team. These are the types of things you talk through with your clients, right, Bill, and your customers as you're working through, hey, what are your best options? What are some things you can be doing? What are your goals? Like this whole picture financially that you put together helps you determine what's going to be the best option for someone.
Yeah, we absolutely want to understand your whole scenario so that we can put together the very best loan structure. And again, we're one part of your wealth team. We work a lot with financial advisors and CPAs. And basically the idea is what's going to make the most financial sense for you specifically. And then we're going to tailor the option towards your scenario.
All right. Well, the best way to get started is just text the word LEND to 21,000. You can do that right now. Begin that conversation with Bill and the team there at Cross Country Mortgage. But also check us out online, smartmortgageshow.com, to learn more, maybe answer some other questions you might have as you begin that home buying process and look for different mortgage information and educations out there. That's what we try to do every episode right here on the Smart Mortgage Show. Hope you have a great week, Bill. We'll talk to you again soon.
Thanks so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.